take one time, only take one time, only take one time, only take one, only take one time, only take one time, only take one time.
Hey everybody, welcome back to Teaching Thursdays. We hope last week you were able to catch up on some of the past videos, and we actually want to add a new element to our Teaching Thursdays where one Thursday out the month we want to dedicate to just kind of bringing everything together what we've previously talked about. So we're going to go ahead and talk about stocks, bonds, mutual funds, and ETFs. Make sure you check out those individual videos so you can get more of an idea of what they're about. Now stocks, we use the example of a whole slice of pizza where a corporation is the whole pizza, and if you buy a slice of that pizza, you buy a share of the pizza. And that's in essence how stocks work. You buy a share of that corporation and now you have equity or ownership in the corporation. With a bond is known as a fixed income investment because you're going to get paid interest on the principal money that you lend to the company or to the government. So, the government, they'll use your money for whether if it's like roads, different projects around the city or around the country. And then you're going to have your corporate bonds where they're going to use that money to fund some of their operations at the company. Now, because you're loaning the money, they're going to pay you interest. So you can get anywhere from, probably 2 or 3% to as high as 10%, just depending upon the type of bond that you have. And the corporate bonds actually tend to pay a higher percentage out as opposed to the government bonds, and municipal bonds pay higher out than the treasury government bonds. But it's a fixed income investment because you're going to get paid. Let's say you get 10%, where you're going to get that 10% is over 1 year, and you're going to get 2 payouts, and it's every 6 months. So whatever that 10% is, so let's say you put in $1,000 and you're going to get a 10% coupon or a 10% interest. You're going to get paid $100 for allowing them to use your $1,000, and that $100 is going to be split into 2 payments. You're going to get $50 after 6 months, and then $50 again, and then at the end of the termination of the bond or maturity, you're going to get your money back that you put in. With mutual funds, a mutual fund tends to be a basket of investments, and it's usually going to contain your stocks and your bonds mixed together. It can be any variation, but it's just a culmination of things, and mutual funds tend to have a higher buy-in. You might need at least $2,000 or $3,000 to buy into the mutual fund. But a mutual fund, if you think about it, all of the companies are shares in the fund. Let's say the money that the fund is worth divided by the amount of shares is going to give you an NAV, which is a net asset value. And so let's say the net asset value is $100, but it costs you $1,000 to buy into the mutual fund. So in essence, you get about 10 of the net asset values, or 10 shares in the mutual fund. And a mutual fund is basically, like we said, it's a basket of securities mixed in together, and there's going to have a fund manager. So there's someone that's actually working the fund for you to try to get you the best return, and then you can have a front load fund or a no load fund, and usually that just simply means that either you have to put money in up front, or you don't have to put money in up front in terms of like for fees. These are just different elements of the mutual fund. An ETF actually works like a mutual fund in that it's a basket of stocks put together. However, it trades like a stock itself. So think of like a basket full of different stocks like a mutual fund would be, but it's on an actual stock exchange like the NYSE or the NASDAQ like a stock would be. So the ETF, which is known as the exchange traded fund, is going to, and that's think about the name, exchange, stock exchange, traded, it traded like a stock. Fund, it's just like a mutual fund. That's why it's called an exchange traded fund. And these ETFs can actually be broken down into sectors and industries. So you can actually buy a technology ETF or a retail ETF, a financial ETF. And with a technology ETF, now you might be buying into companies like Facebook, Apple, Microsoft, Intel, all in this one ETF. But if you can afford all those shares, the ETF might only be about $50. Well, you can afford $50 as opposed to maybe $500 that all of those companies might cost you. So ETFs have a benefit. They also will take into consideration the dividends from all the different stocks within the ETF, and you'll get paid out a dividend with that ETF as well. So this is just pretty much a refresher about stocks, bonds, mutual funds, and ETFs. Make sure you check out those past videos. Those are some of the first videos that we had, and just to get more in depth and more information about it. Peace.
Only take one time.